Hi, I'm Bob the Mortgage Coach Mitchell, and today we're doing a content video, not just a glossary thing. I know you guys have been seeing that sometimes and thinking, damn, is he ever going to get done with those? Well, I'm about halfway done. But anyway, it doesn't matter because today we're going to be talking about how to address the affordability crisis in real estate. Over the last few years, matter of fact, I'd say probably over the last 5 or 7 years, real estate values have been going up. And then once the pandemic hit, things got downright crazy. People became more focused in on their home and owning a home and that sort of thing. And basically, because there's a shortage of homes out there right now, the increased demand with the lack of supply, well, the laws of supply and demand caused housing values to go up. Now, the other thing that happened during the pandemic years were that there were supply shortages. There were disruptions to the supply chain, and that caused values and inflation to rise. So the end result was that the Fed had to step in, and in order to attempt to calm inflation down, they've raised interest rates, which have brought mortgage rates to one of the highest levels that they've been in probably about 20 years or so. So anyway, the combination of the two, the real estate values going up and the mortgage rates going up, has led to an affordability crisis. Now, in reality, in most markets, I honestly don't see real estate values coming down. As we've talked about in previous videos, the population of the United States is anticipated to grow and to reach, I think it was like 450 million people by the year 2050, which is like 27 years from now. So that's like a 23% increase. So if that comes close, we're going to have to house these people somewhere, and that's going to lead to kind of a floor to real estate values, supply and demand again. If you get that many more people we have to house, then their chances are we're going to have to build something for them. So anyway, I guess my point here is that real estate values, I don't see them coming down anytime soon. Now, mortgage rates, they might or might not, depending on if the Fed overshoots what the response is right now. So far, what the Fed has been doing, and I know there are a lot of other mortgage bankers out there are crying in their milk because the raising of the interest rates have slowed the demand for houses, and there's not as many mortgage applications going on and that sort of thing. Unfortunately, that's exactly what the Fed intended, was to slow things down. By slowing things down, people can't charge more. They have to, in order to get the deal, they're going to have to, put the capiche on rate increases and on price increases. So anyway, the end result is that the Fed is doing what they're doing. When this all first started, it looked, from what I could read, it looked like the inflation rate was somewhere around 9-10%. They've since got it down to about 4 or 5%. Their stated goal is 2%. So chances are they're going to continue raising rates for a while. Now, that doesn't mean that they are all knowing and can accurately predict how this stuff is going to work out. Generally speaking, in my experience, has been they keep going until they overshoot. Once they overshoot, the market responds, and all of a sudden, boom, maybe we're in a recession, and that recession at that point allows them to stop raising interest rates, and depending on how long it goes, maybe even to start dropping interest rates. So housing values in the short run, medium run, I don't see them coming down. Okay, mortgage rates might or might not, but we can't count on it. So that being the case, if you need or want to buy a house right now, buying a house, as I've talked about in previous videos, is not necessarily a bad thing right now. Because interest rates are higher, you're not having as much competition out there as what you were just a few 8, 9, 10 months ago. I mentioned before in other videos that a house up the street from me went on the market. This was towards the end of the whole pandemic housing crunch and everything, and people were talking about housing values plummeting and that sort of thing. Anyway, they put it on the market, and about 15 cars were parked out front on the first day that they were allowing for showings. So now different markets have been affected differently. I happen to still live in a very hot real estate market, but generally put, if most markets are going to stay steady. Once the rates do start coming back down, we're going to be back off to the races. So anyway, now it could be indeed be a good time to buy a house, because you're going to be facing less competition. During the worst of it, if you needed to get a mortgage and didn't have the ability to pay cash or to put huge amounts of earnest money or due diligence down, you were basically left out of the process. So anyway, now's not that case. Their houses are sitting on the market that have been on the market for 30 or 60 days now. That was unheard of during the peak of the home buying frenzy. So anyway, what are some steps that we can take in order to get you into a house that you might be able to consider to help address the affordability? Well, the first one is starting small. Okay. One of the things that kind of, I don't know, maybe I just sound like an old guy griping and bitching right when I say this, but one of the things that's amazed me here recently is when I'll see a young couple, 22, 24, 25 years old, and their first house, the first house they're ever going to buy, they want the 3,800 square foot McMansion with the 3-car attached garage and the pool in the back. Okay, I knew one young couple who that's exactly what they wanted. And now they both had good jobs, and they both graduated from college and got good jobs and could afford the payments. But that was when interest rates were 2.5%, 3%. Now that interest rates are 6.5%, 7%, maybe even a little bit over 7%, depending on your circumstances. And housing, that same house that 3 years ago might have been $400,000. That same house is now $550,000 or $600,000, and the interest rates have doubled. So while they could have afforded it before, maybe they couldn't if they're trying to buy that exact same house now. So if you're in that situation, the first thing I'm going to ask you is to go ahead and consider a smaller home. Okay, do you really need the end-all be-all home, the 3,800 square foot? Do you need to have a bigger house than your parents have? If you do, then by all means, if you can afford it, go out and buy it. But if you're having trouble affording it, then maybe you should consider buying a smaller, less expensive house. Okay, just one consideration. Now, the average person stays in their house for about 7 years. So if you buy a house today, chances of you still being in that house 7 or 8 years from now are fairly slim. I don't remember the exact statistics, but the average comes out to be about 7 years. So by starting small, you'll have a chance to buy a house, build some equity in it, and then when you sell it, use that equity to put a bigger down payment, maybe to be able to afford to put a big enough down payment to avoid private mortgage insurance, that sort of thing. It's a little bit easier if you have a house that you're building equity in. So, number 2, buy an ugly house. You might have seen the billboards that are around several cities. It's a franchise that it is owned by generally speculators who are looking to buy houses to fix up and flip. And their big thing, the big billboard is a big yellow billboard called "We Buy Ugly Houses." Well, you too can do the same. It's been my experience that about probably 90 to 95% of home buyers want something that's ready, that's turnkey, that's move-in ready. Okay, so if you got ugly asbestos siding on the outside of your house, or maybe old vinyl siding that's got cracks and pits in it and that sort of thing, the roof has got stains on it, or the fascia boards have got peeling and bubbling paint on them, maybe some of the wood's rotten, maybe the grass is overgrown, that sort of thing. If the house lacks in curb appeal, it's going to sit there. So, and if it sits there, the sellers are more likely to accept a lower offer for the house. Again, you're going to have less competition because 95% of the people want turnkey. So if you consider buying an ugly house, it needs some work to be done to it. Now, I'm not saying that you have to go out there and totally rehab the house. That can be expensive, and it's fraught with the perils of of screwing up and not necessarily doing a good job on the rehab, or if you both got jobs and you work a lot and you got kids and dogs and that sort of thing, maybe you don't have the time to do that. But as far as having somebody come in there and replace siding, shop around, see what the best deal that you can get is, and then hire the job out. It's really not that hard. The siding that I put on my house took probably about 4 or 5 days for them to get the old stuff off and to put the new stuff on. So anyway, consider buying an ugly house. Number 3, buy her further out or closer in. Okay, I got on the, it wasn't the MLS, it was HomeSpotter. But I got on HomeSpotter the other day, and I did a search around here in my neighborhood in Cary, and the least expensive house that was on the market was like $325,000, and that was for a really small house that needed a lot of work done to it. So maybe you couldn't afford to buy in Cary. Okay, but maybe you can't afford to buy in Garner, or if you're in a different market, maybe you can't afford the ritzy suburb, but maybe you can afford one that's not quite as ritzy. So, generally speaking, when you get further out from metropolitan areas into the exurbs, I think they call them, not the suburbs, but the exurbs on the outside of that, and then even further out in the rural areas, housing expenses tend to go down. So a house that might cost you, $450,000 here in Cary, or in whatever municipality, that's an up and coming, popular municipality, might cost $450,000, $500,000. That same house 20 miles away might go for $300,000. So consider buying close in or further out. Also consider buying closer in. Generally speaking, and especially if you're in a large metropolitan area, the inner ring suburbs and the inner city tend to have neighborhoods that have had a lot of deferred maintenance, that have been ran down. The school districts aren't quite up to snuff, that sort of thing. You need to take that into account, don't get me wrong, but you can also find a bargain, and you can also find a neighborhood that's in transition, that's going from maybe being a little bit rough to where in a few years it's probably going to be a nice neighborhood. If you're familiar with the city of St. Louis, think about the Central West End. When I was a kid, the Central West End was kind of a rough area. The only thing that was there was the Baskin-Robbins. So over the years, people saw these big old houses, came in and rehabbed them, and all of a sudden the Central West End is high dollar. Same thing with any number of different areas. So if you can identify an up and coming area, maybe that's something you want to consider. If you want to buy something further out, now you have to, that might increase your commute. You have to take into account the cost of the commute and wear and tear on your cars and that sort of thing. But buying further out is something that you might want to consider. Again, this doesn't have to be the end-all be-all of houses. If you buy a house, let's say you do a combination of this thing. You buy a smaller house that has some deferred maintenance, maybe something that's more cosmetic in nature, and it's a little bit further out. The three things might make that a very affordable house, and then in the meantime you can go in and resod the yard. You can plant some flowers, maybe put a walkway in, replace the siding, put a new roof on. You don't have to do it all at once, but over the period of a 3 to 5 year holding period, you might be, and hopefully will be able to build up a sizable nest egg in the form of equity in that property, to where when you sell it, you can then take that lump of money and put it down on the purchase of your next house, which will be a little bit closer to what your end-all be-all would be. If it's not, if you still can't afford the end-all be-all because maybe it's running away from you because those housing values are increasing, okay, at least this is a way to take a step up the ladder to be able to get to the next step. It might not be the end-all be-all, but it's a little bit closer. Live in that house for 3 to 5 years, in turn sell it, put it down there, and eventually, hopefully, you'll be into the house that you want. All right. Buying a multifamily property. Now here in the Triangle area, there aren't a ton of them, but in the city where I'm from, St. Louis, particularly in the city, in some of the inner ring suburbs, there are quite a few 2 and 4 family structures. That's a way to go ahead and help to subsidize your payment. Generally speaking, we can use 75% of the rental from the other units. So say you buy a 4 family and you live in one unit, and you rent the other 3 units out, we can take 75% of the rental from that property and grant that towards your income, to where you might be able to income qualify with that extra boost. So consider buying a multifamily property. Same thing with if there's an accessory dwelling, an ADU, an accessory dwelling unit, I think they call it, in-laws quarters, that sort of thing, or a property that you might be able to rent out, that sort of thing. Next one, roommates. Okay, that's something that's changed. Fannie Mae and Freddie Mac and their Home Ready and Home Possible programs will now allow you to use income that you receive from roommates in order to qualify. Now, there are some pretty strict rules on it. There has to be a history of it being received, so the person's going to have to already live with you, and you have to generally report it on your taxes as rental income. I think it's Schedule E. Okay, but if you do that, and again, if you're planning for further on down the road, maybe you want to do that. Make sure that you have the roommate pay you or pay their share in checks, okay, or at least through a cash transfer from their bank account, to where we can show a paper trail that they've been making the payments. They're also going to be able to have to document that their address by driver's license, that sort of thing, to show that they did indeed live with you. Okay, FHA generally doesn't allow roommate income to qualify, but it can be used as a compensating factor. If the roommate is related to you by blood or by law, that indeed can be used as qualifying income. But again, it has to have a history of being received, and it has to be able to be documented. FHA is kind of a stickler that it has to be on the tax returns. Okay, next one would be co-borrowers. Okay, maybe you can't afford a house by yourself, but you got a really, really, really good friend who's in the same pickle. They can't afford a house by themselves, but together your income can qualify. It's a 3-bedroom house, or maybe you're lucky and find a house with 2 master suites. Anyway, consider buying it. Now, if you're going to go that route and buy with a co-borrower, make sure that you write your agreement out and that all your expectations are put out and everybody understands what they're getting into. I strongly encourage you to write up a detailed agreement so that there's no surprises, that everybody's on the same page. But it is another thing that you can consider doing, would be getting a roommate to be a co-borrower on the loan, meaning that they can buy the house, that they have a 50% undivided interest in the property. When you sell it, you're going to have to split the profits, but half a loaf is better than no loaf at all. Okay, next one, gifts. How's grandma setting? How's mom and dad? Brother, sister? Most people think of gifts as being a large thing. It doesn't have to be, and families can pull together. Okay, maybe your cousin can toss in $100 towards you buying a house. Maybe your grandma can buck up $5,000. Maybe your parents are willing to come up with $10,000. It doesn't always have to be a huge amount of money. Sometimes it's just a matter, say that you already have 10% saved that you can put down, but you can get grandma to come up with the other 10%. That meeting that 20% down payment keeps you out of mortgage insurance. So it's something to at least explore the possibility of. Now, it might be that, that they're not able or willing to do such, in which case, oh well, so be it. But it was worth checking into. Okay, increasing your down payment. Now, you can do that by savings. Unfortunately, the problem here is that as you're saving for a down payment, this is why Dave Ramsey's an idiot, by the way. If you're saving for a down payment, housing values are getting more expensive every day. So as home values rise, as you're saving money, it's a moving goal. Okay, so anyway, but if you can, save as much money as you can. If you're I've talked before about spending diaries. Figure out where you're spending your money and where you can free up some money to be able to increase your savings. I don't know if you remember in an earlier video, I talked about my super big gulp habit, where I used to stop and get a super big gulp on the way to work, and then I'd stop on the way home and get a super big gulp. Well, those reached like $1.19 or something like that. So it came up, I was spending like $2.60 a day. It doesn't sound like much until you figure that's about $800 or $900 a year that I was wasting on just super big gulps. I switched to brewing tea at home, and that's an extra $800 or $900 that I can put away towards savings. Same thing on cable packages and all that sort of thing. We do have another video. I'll see if I can find the link and put it in here on how to free up money to save. So savings is one option. Selling assets. Okay. That's another one. Most people don't realize that, especially a titled asset, something that you can document that you own. Say, you have a motorcycle, okay, and you love your motorcycle, but you'd rather have a house. Okay, well, if you got a good equity position in a motorcycle, you can sell it, and as long as we document the transfer and the transfer of the money, we can use that. Now, on a titled asset such as a car, an RV, or a motorcycle or something, that's a lot easier, but it doesn't have to be a titled thing. It can be something that we can just document that you owned. I had one person sell a stamp collection. Okay, and we documented it that he had an insurance rider on it that showed that he owed it and what the appraised value was and that sort of thing. And we were able to use the money that he got from selling a stamp collection. Now that was a fairly substantial stamp collection too. I mean, it wasn't just like 2 or 3 stamps. I think he had like 3,000 or 4,000 of them, and several of them were worth hundreds and thousands of dollars each. So he actually was able to raise a substantial amount. But again, it just illustrates the purpose that you can indeed sell an asset as long as it's properly documented to be able to come up with the increased down payment. And again, on the increased down payment, it's not so much the extra $1,000 that you put down. If you put it for every $1,000 that you put down, you're probably going to be knocking $6, $7, $8 off of your payment. So that's not a huge thing. But if you can get to that 20% mark where you can avoid PMI, the increased down payment could really make a big difference. Okay, and then the last one is down payment assistance programs. Okay, most of these you have to income qualify, but not all. Now, I'm most familiar with the North Carolina Housing Finance Agency Down Payment Assistance Program, which is a state agency, and most states have some sort of equivalent, and they offer down payment assistance programs. Now, sometimes those are income driven, which you might or might not qualify for, but it's worth checking into. Now, again, as far as the affordability of it goes, if you're going to use that as 100% of your down payment, then you're going to be not necessarily bettering your position as far as the payment goes. So, but you can use down payment assistance in addition to your down payment. And again, if you can reach that 20% level, you can avoid PMI. So, and the PMI can be, depending on the value of the house and what your credit's like and all that sort of thing, could be a pretty good chunk of money. It can be several $100s a month, which if you don't have to pay it, then go towards buying a bigger house. Anyway, this is my longest video to date, so I'm going to call it quits right now. If you have any questions about how to address the affordability crisis, please feel free to reach out to me. I am Bob, the Mortgage Coach Mitchell. I'm here to help you. If you have any questions, definitely feel free to reach out to me to utilize me as a resource. I'm really happy to answer those questions. Now, if you're in a state where I'm not licensed, I might not necessarily be able to help you on your mortgage. But if you are here in North Carolina, definitely, I'm not going to turn you down if you want to do your mortgage with me, but that's not the point of this video. Anyway, I'm Bob, the Mortgage Coach Mitchell. Now, be it here or somewhere else, let's put you into a house. Bye-bye.